course, for those of you who've been watching the show for a while, you know that we start off the show with a weekly market summary and really just talking about what we saw in the market. Asset management is one piece of a retirement program, right? So even if you're not retired yet, the more you can learn about asset management, the better, because a lot of the incomes and what have you that you might be generating is going to come off of your investments. And so, we have other things like pension and Social Security and rents and what have you, but then you're going to be saving money, hopefully, and now you've got to have somebody manage it, or you manage it, or whatever the situation. Irregardless, it's better to understand what's happening. And so you can see here, this is the year-to-date chart for the S&P 500, and that red line across there is kind of connecting the peaks that we've had. We've now had quite a few. The very peak for the market was back on January January 3rd or 4th. And, obviously we've had the very low is right here over my shoulder, and that's October 12th. So 28% drop, right? We're in a down market as defined by classical definitions in the sense that the peaks are lower on each one of these, run-ups, and even the troughs, the bottom portions here are lower also. We're hoping to try to get a new trend established to the upside here, but we just had a failure this week on Tuesday. You can see if you look closely, we touched the red line. We did get above the 200-day moving average a couple times over the last couple weeks. That's actually a big deal, but it didn't hold. We kind of fell below that. So this week we had some crazy things happening, I think, that are really important to understand. Number one is we had the inflation report that came out. Everybody thought it was going to be about 7.3% to 7.5, somewhere in that range. Came out at 7.1, so that's fantastic. Really good situation because we need inflation to keep coming down. And it was better on the core inflation. It was better on year over year. It was better on month over month, all better than expectations. So the market was hanging in there, and that's when we really touched that trend line. Unfortunately, the next day, the Federal Reserve met. And so their objective, in my opinion, is to try to make sure that the stock market doesn't go running off to the upside, because they have a thing called financial conditions. So they'd like to see financial conditions tighten in this environment so that basically there's less money floating around that can push inflation. So if they can talk the market down, that actually helps them along with all their other tools. So yeah, they came out and said, we're going to raise rates more than we said last quarter for the terminal rate. We're going to probably keep them up all the way through 2023. And the market responded negatively to that. Not dramatically.
No, it wasn't a big movement.
Yeah, but yeah, definitely, there was, kind of a hangover there. Then we had, Europe and all these other central banks basically the next day, Thursday, come out with their rate increases, all 0.5% for the most part, as far as that goes. And so we had a pretty bad day yesterday. And the combination of kind of what the Fed was saying, on Wednesday and what happened in Europe, but then also there was a retail sales report that came out that was worse than expected. And so, of course, this brings on the fear of recessionary situation because the consumer is the one hope we have of being able to kind of soften that recession as far as that goes. And now, the other thing to keep in mind this week that's very important to understand, you can see it's quite a dramatic drop from that high point with those red boxes. But we have quadruple witching day today, right? So I know that sounds interesting, but what it is the expiration of options and futures contracts. And oftentimes the market gets very volatile and usually actually ends up going down both the day before, which is yesterday, and today. So I would be a little careful of drawing too many conclusions from these downturns. Let's wait and see what happens on Monday before we get too worried about what's going on as far as that goes. And so I have another really key point that I've been trying to make to the clients here all along, and this is a little hard to see, but what we have here, this is the SPDR S&P 500 ETF. The ticker symbol is SPY. And going back to 2010, right? And so if you look, I've got a blue line there kind of running all the way through, all the way up until today. And what that blue line is called a regression line. And so it's the average of the prices up until the pandemic.
Yep.
And I just continued it past there. that blue line, the angle is 14 degrees. So basically the market was marching along at kind of a 14-degree upward angle.
Kind of like a steady, easy hike up.
Yeah, and you could tell it wasn't always up or down. There's a little variation around that line. Basically the stock market is a representation of human emotion, so it's never a perfectly straight line, right? Because it's human emotion. But then the pandemic hit, and you can see that big drop there, right? Kind of that cliff, fastest 35% drop in history. And the governments came out and they flooded the markets with money and quantitative easing and lowering of interest rates down to zero or even negative in some of the European countries. And you see, and I've drawn a little orange line through there. It's a 54-degree ramp up from the bottom of that pandemic to the top of the market that ended up, very beginning of this year. And so if you think about that, that's not sustainable.
No.
Right? And so I'm having clients conversations, and they're like, oh, we've lost so much money. And they're right if we look at that top point, right? But what's really fascinating is that it's not, in my opinion, so much that we've all lost so much money from that high point. It's that we temporarily got more money on our statements than we probably should have had, caused by the pandemic.
Yeah.
That's a pretty interesting thought. Think about that for a minute. No pandemic, we're still on that blue line. And actually, if we were still on that blue line, all of us would probably have even less money on our statements right now, because we're still slightly above that, than we actually do. And we wouldn't be unhappy with it either, because if we still had marched along on that blue line, we're still growing at this 14-degree, positive slope, and we're okay, things are going all right, we're doing fine. It's just because we had a pandemic, they pushed out so much money, it drove the market up at a 54-degree angle, non-sustainable, created high inflation. Now they got to pull that money back. And they do that all kinds of different ways. They do that by, doing quantitative tightening for the Federal Reserve here, for example, and of course raising interest rates. And we've had a pretty decent amount of interest rate increase this year. So we're coming back down, I think, to kind of some normal. Now, of course, life is not a straight line. We might not quite get to that line. We might go below it. We'll have to wait and see. But I just think mentally it helps a little bit to kind of understand that it isn't so much that we've lost money. It's the kind of the opposite of that, is that we had more money than we should have had temporarily. Now, some people got out at the top, right? And pulled money out and did different things. And we actually sold a bunch of things that did really well in that run up to there at the beginning of this year, for example, that turned out to be good things to sell. But nonetheless, it's very hard to kind of say, capture all your money. I'm getting everything out at this top. And, that doesn't happen very often. And so I think this is a really helpful thought process for people to kind of understand what's going on, and that we're just kind of going through this scenario. And again, we might actually have less money than we have now, even though we feel like we've lost so much. But we might actually have less money if we wouldn't have had a pandemic.
Yeah. Would you say this is kind of similar to that 2000 bubble that we had, where things got inflated out of control and it kind of popped and came back down?
Yeah, the best 5 years in the history of the stock market is 1995 to 2000 for rate of return. And if you think about what happened then, see, in 2000 we had this Y2K, right, the Y2K bug, and tons of concerns about that bug. Computers are going to crash, planes are going to fall out of the sky, cars are going to stop on the freeway, all of these things. And so the Federal Reserve started pumping money into the system, and pumping and pumping. And if you look at where that peaked out and where it started to fall, the Fed started pulling that money back in 2000. So we started seeing big drops, February and April of 2000, June of 2000. And that's the same thing. They just overpumped things to get that going. We didn't actually have all of those crazy things happening for the Y2K, but nonetheless, the Fed was overinflating, big bubble, same craziness too. These dot-coms, companies with no earnings, companies with no revenues, companies that didn't really have a product that were going crazy, very similar to what we saw here. Companies like Rivian, went public, didn't even have a truck that they'd made yet. They were worth more than Ford, I believe, at one point. There was many of these stories. And so it's the same thing. It's too much money. Now, here's the good thing about this. Eventually, we're going to get back down. And the markets generally will be more, I think, evenly allocated. We won't be spending money on crazy things like these IPOs. That money will be going into companies that are doing real things. And so I really feel like there'll be a quality component that really does well here, maybe value stocks or really, high cash flow stocks and what those types of things, because, everybody's gotten burned on the SPACs and the IPOs and all these crazy things. They're all down, 50 to 90%. And so now they start to look at the real companies that do well, and that money gets reallocated. Well, cryptocurrency. So there's another crazy, right? Which was, what was that, 3 trillion? Now it's 800 billion or something in that neighborhood. And so that's just part of the bubble. That's kind of the same things we saw in 2000, right? So yeah, it's very much so. This is very much so like that. Too much money pumped out, being taken back, creating a big downturn, right? So I guess one difference, though, that we have here is that in 2000, by this point, we had a lot more unemployment because there was a kind of implosion of all those dot-com companies that we haven't seen yet. And we didn't have pent-up demand from a pandemic where everybody had to stay, in their homes or what have you for some period of time, that are now really excited to get out and do things, right? So that might help us to have less of a downturn, because 47%, 45%, one of those two was the downturn from peak to trough in the 2000. We're currently at 28% from peak to trough. I don't know, we might go lower than that, but we might not go to 47, just because this is a little bit of a different situation in that businesses are fairly healthy in terms of where they're at. Banks are healthy, which is important. That created a big problem in 2008. And consumers are actually fairly healthy too, as a whole, right? So, and so maybe we have a softer landing here than we do in some of those others. I want to just continue to talk about the fact that even though the stock market is dropping right now, we're seeing a decrease in the yield on the 2-year Treasury, okay? So the Federal Reserve comes out and says, hey, we're going to raise rates even more, and the 2-year Treasury goes down. That's not what's supposed to happen. So what's happening is the Federal Reserve is saying, hey, we're going to go up to this rate, and the 2-year Treasury in the bond market is saying, no, you're not. And guess who's been right so far? So September of last year, they said they weren't going to raise rates at all in 2020. Oh, wow. 4+% rate increases for 2022. For 2022. And now they're saying, okay, we're going to raise rates to this higher level, 5.1% terminal rate. The futures market now says 4.8%. Futures market's been right. Fed's been wrong. And they're also saying that they're not going to decrease rates at all. Most likely, Chairman Powell said in the question and answer session, probably not going to be lowering rates next year. Those are things that drive the market down, because the market actually kind of thinks, okay, if they do that, they're going to make a mistake. Because the overall futures market is showing rate cuts in the second half of 2023 right now. And that's been true for that futures market for quite some time. And so the reason that these things would be coming down is because the economy softens so quickly that they're having to actually back up and say, wait a minute, we need to take some of this increase in rates off the table and come back down a little bit to keep us out of a big recession as far as that goes. I think the other thing that's happening is that inflation is probably going to fall faster than people think. Rents are a big part of core inflation, and rents are a lagging indicator. If you look at current rents that are being paid for, they're much lower than rents that are currently in the CPI, and we'd already be back down quite a bit if we had those rents, and we're going to have those rents. They'll be in the report. Wages are actually falling in terms of the increase. That's coming down faster than we currently have, right? We saw that last week when we talked about the Indeed. You look at current jobs versus, that are being offered versus current jobs that people are working in. So there's some significant things showing inflation's going to be coming down, but I do think the focus is now shifting to recession, right? And how bad that's going to be. And so what we saw was a report for the retail sales that really got this downturn that we're in now, Thursday and Friday, started. Again, it's quadruple witching time, so it doesn't take much to get it going down. But the report was that this retail sales dropped 0.6% in November, right? Expectation was 0.3, so it's a big difference. But the report, if you dig into it, is geared towards goods. Things that you can buy on Amazon, cars and refrigerators and all those type of things. And so we showed you this chart last week, which I want to reiterate. Number one is overall total consumer spending is doing pretty well. It's continuing to move up. But if you look at the blue line there, that's goods. See how it's bottom, it's topped out.
Yeah, it's stagnating.
Right? But even in this report that came out on Thursday, the service, there's only one service part in this report. Not a great report, but the market responded to it. But the service portion in there was restaurant and bar sales are up 1%. Mm-hmm. And so we can see it. If we look at this yellow line here, services are still growing.
Yeah, next week we'll have another kind of retail report that's a little bit more geared towards services.
Yeah, it's at least balanced. And I think that's the key thing here. And so this is very fascinating because what's happening is it makes sense, right? We were all stuck in our homes. We could order goods, and so we did. And we redid our homes, we redid our yards, we bought, Pelotons and whatever we had to buy. And, I saw on the way here to work today, there was one of the exercise machines, so an elliptical trainer just right out on the sidewalk or, right next to the sidewalk with a free sign on it, right? So there, somebody's trying to get rid of something they probably got during the pandemic. And we're now spending that money on restaurants and bars and hotels and airline flights and what have you. And so what is happening, if you think about it, we've gone from a situation where, the supply chain issues were China shipping. Remember all the ships, outside the port of LA backed up and what have you, to now services, which needs labor. Mm-hmm. And so the tightness is in labor. And so we are continuing to see pretty good reports about labor, including this week. The first-time unemployments were 20,000 applications, less than expected, right? So labor is still good. Wage growth is still happening. Maybe it's going to slow down some, but it's still happening. And so those are good things that might be able to kind of help us in terms of the recession side. And so we got to focus on what is really going at any point in time. And again, we're coming out of a pandemic, hopefully. And really, it's different. This is not the same as normal, situation. This isn't going to be a normal recession. This hasn't been a normal downturn. This hasn't been a normal bubble. All of this is different, and so we got to kind of, analyze that. Just quickly, again, we showed this last week. I think this is super important. 2 quick points. Number one is the average rate of return for a recession while it is happening. Declared recession to the end of the recession, was negative 1.5%. Pretty big range, right? Negative 35% in the 2008. In order to get these big negatives, something has to break, in my opinion. And what could that be here? Honestly, if you know what it is, it's probably not what it is, because it's the things that you don't expect that cause the biggest scary things that happen in the market. If you look at the last bubble that we had in 2000, right, the market was down 7.2%. So that's a little bit like this. If you look back to, what happened in the high inflationary periods, we've got a couple of them in there. 73, it was down 18, but 80, which is another high inflation, was up 16, it was up 14 and 81. So, if something doesn't break, we might not have a terrible scenario during the recession as it's happening. And again, we're dealing with a pandemic here. And then again, I want to show you this chart because this is, again, too many numbers here. But just to make a point, this shows for the last, since 1957, we've had 9 recessions. If you look at what happened once those recessions started to come to an end and after them. So the first column here shows the S&P 500 return 3 months before the end of the recession. It's up 12.9% on average. That's really good, actually. I'd take that in a 3-month basis. Yep. Yeah, it'd be great. 1 year after, it's up 15.1%. 3 years after, it's up 40.1%, and 78% on a 5-year basis. So we might have some pain between now and the start of this recession, but once we get towards the end of this recession, if it does happen, things will start to get better. And this is, historically anyway, this is the silver lining in all this. Now, here's something else to notice. If you look at this, this is a 9x4 square, right? 36 data points altogether, not including the totals. Out of those 36, they have positive rates of return in every single one of them except for one. So very high probability that we will have positive rates of return when we get towards the end of the recession and then after, right? So that's what we're kind of waiting for, and that's what's happening right now. I wouldn't be too concerned about what's going on with the downturn that's happening here. Let's see what happens next week. You know, December is generally a good month. Matter of fact, it's the best month. So hopefully we see some rally coming out of this kind of, I think, maybe overstretched downturn that's caused at least somewhat by this quadruple witching hour. If we don't, then we'll get more conservative with our allocations. We currently have 3/4 of our stock market exposure in. We'd probably cut that back and just wait through this downturn that might happen. You do have to be careful. You can look at things and say, hey, the treasury yields are doing this and this is all, and so the market should be going this other direction. But you got to pay attention to the price. It's called don't fight the tape. Right, and so we'll move with the tape if we have to, but I do think things can kind of settle in here. We're really going to be paying a lot of attention to earnings next year, especially that first quarter, to see if this recession concepts and these higher inflation and higher interest rates are going to have much impact on earnings for the companies that are out there. So anyway, good time frame to be watching the market, and kind of a lot of things that we can learn here too. So.